for here. So we're Massive Capital. Most things in life are like an open book test. The question is, do you know where to go and look? So we're on our third installment of the series, Government, Friend or Foe. And for those of you that have joined our last two, you know it's been a fantastic journey. They are up on YouTube if you missed it, and this will always be recorded and shared. So we'll talk a little bit about who Massive Capital is, partnering with us. Then we're going to go through tax strategy and Q&A. Last time we had a lot of Q&A during the presentation, but it was super valuable for everybody who attended. So, and we want to thank Bill for always making time to join us.
And we have a party after the party. So if it continues over, stay tuned, no problem.
Awesome. So Bill is the only professional in the room, and we're still not even giving a professional accounting advice because it's all individual. So this is for educational purposes. What we like to explain is what we know, what we do, what we believe, but you always need to check with your own tax or accounting or legal professionals. So as you can see, the Massive Capital team is crazily growing. So along the top row, you'll see all the regular few of the faces that you're familiar with. We're now merging with Realty One. So Grant, thank you for joining the call tonight. And so you'll see we've really rounding out our team. We are now massive for sure. So a little bit about the portfolio. So Realty One partners, you can see at the top, they have 71,000 square feet of retail, 252,000 in retail centers. They have about 499,000 square feet, a total of 290 million. And if you look at Massive Capital, we have about 36,000 square feet, 90,000 square feet with X space, about 1 million square feet, and we have a total of about $145 million. So we're getting close to that $500 million mark, which is crazily exciting. Here's a little bit about all of the different portfolios and things that we have. So you can see last year we closed about $140 million. This year we've done several deals. So land development just outside of Austin, Amberwood Apartments. We did a value add, which we just officially closed on our raise on that last week. New X space development. So we've officially stopped raising for that one and it's closed out and we're moving to the development. And then we're working on the next 3 projects that you're going to be invited to. Be sure to attend all of our webinars so you don't miss out any investment opportunities. So this is a little bit about all the different things that we do. So we have equity all through here, the brokerage, property management, development, construction, education. And then, you know, so we bring in LP institutional money, acquisitions, leasing, retail flex space, retail town center, multifamily, and we have an in-house general contracting now. So again, you can see we've grown quite a bit. These are the markets that we have assets in. And as you can see, we're all in pro-landlord, pro-business, friendly states with great migration, great benefits. Where you put who you give your money to is most important, and then where you put your money is next important. So here's just a little bit of the story, what we do. So we're getting a little bit more into land development and land. So we actually, I'll try to find it here. We do have a link now that we're looking at new land deals. We'll do joint venture, new development construction, and then credit improvement. So we'll co-sponsor to give the liquidity, everything that people need. And then multifamily, it's been our bread and butter for a long time, but we'll sponsor a project that has heavy CapEx versus risk. We'll co-sponsor to provide additional management and asset management, and then a co-sponsor so that we can bring our balance sheet to existing GP teams. And then education, we have our own in-house education program. So we have a great customer management system that we use for contacting our people that we want to have invest. We have a certification that we help you get educated on how to do it. And then we have an accelerated program where we teach partners how to basically become a GP. We call it the fast track to GP. So you'll actually literally work on deals as you're learning. And it's a very fantastic learning environment. All right. So you want to talk about this? Because I know
Yes,
you're excited.
absolutely.
And
Yes.
my voice is
So-
starting to fail a little bit.
Okay, Trevor, I got it from you. Thank you. By the way, big thank you. Big thanks to you, Trevor. I know you were sick, but still you made it through today. I appreciate you being here with
Yeah.
us.
I can't miss these. These are awesome. I learned something new every single massive webinar. So that's why I'm a big, tell everybody to join.
So I wanted to shout out, give a big shout out to all the supporters and all our followers, investors, and our friends who made our first virtual webinar or first virtual conference a big success. We had over 500 people attended and over the course of 2 days, last Friday and Saturday, day one, and we had 121 attendees per session. For each session, 7 sessions in a row straight. We peaked at some point almost 200 people, and then day 2, 58 attendees. And the platform, we had really good feedback on the platform that we use to host the sessions. All in all, we appreciate everyone who's supporting and us throughout our entire journey. So we go live for our second webinar, our second virtual conference for November 3rd, this Friday. Massive multifamily.events is the link. Please go out there, take a look at it. And that's the way we host, we showcase all of our virtual conferences and in-person meetups that's coming up in Dallas in Q1 next year. So, and second one is, this is Cottonwood, Denver is one of our favorite markets. We like it because it's the tax and the insurance exposure to that market. It's a good balance for the Texas investments that we have. This is our second asset for the same team. We're looking at a third asset already. So we have 2 spots left. Anybody who's interested in the Colorado market. It's a very good risk-adjusted return for us. I want to share that, hey, take a look at it. You can go to our website and I can go from there. All right. So Bill, thank you again. And our tax framework, what I will do is as I get into the tax framework, this is our third session. First session, we talked about the typical tools that we could have. Second session, we talked about some of the practice that we can do. And today we'll do a live case study where we're going to come up with hypothetical income and tax for 2 different people that I know of. I talked to them, and then we'll run that by that what happened in the actual space. And if we give that to Bill, how will he go about it and get some more money in our bank account, right? So this was the first session. What we did, we talked about the tax strategy, to give you an idea about the total income versus taxable income, right? First thing first is, yes, money that we earn, most expensive. Money that our money earns, that's the least expensive. So on the left side, we always say pay attention to your tax rate and then look at the depreciation. Then those are the tools that we have that we can use for us and follow the rules and defer the tax, reduce the tax as much as we can. So that was our first session. We have a recording that's on the YouTube. If you want to please go take a look, it's going to help. Key takeaway is that tax, we need to make sure our P&L is healthy. We need to have a strategy and we need to have a review. We all need to spend some time with the right set of people who are specializing in the tax. And those are the tools that we have. As an investor, we need to have as much of a tool, as many tools as we can in our toolkit so we can deploy rightfully so. In general, for most of the household, we see W2 income, business income, and investment incomes. And then sometimes we say, hey, I have a W2, I want to stay in a W2, but how do I reduce my burden? First thing we say, increase the revenue and then reduce the burden, right? And those are some of the other buckets, pre-tax, post-tax. And as you grow, you'll get into trust, 1031 and DST. This is the, not the Delaware, right? This is the deferred sales trust. We did a case study on a working couple and also a working couple with 1 W2 and 1 owns a business. We'll talk about today. It's the second scenario and one more time. This was the second session most that we talk about, that what are some of the possible strategies. I'll come back and revisit that in a bit. So in general, everything has a framework. And one of the things we say, life is open book test. We just need to know what chapter to go for whatever questions we may have. So possible strategies, you reduce the taxable income. You don't go after reduction of the gross income, right? You go after the taxable income. Then you increase the tax deductions, maximizing the tax credits. Then sometime you have to time them right, where income and deduction come into the play. And sometime you'll get into the restructuring the investments, whether I buy stocks or I buy, multifamily assets or commercial assets. But all in all, the takeaway is that all of us as investors, we need to improve our tax understanding. And at the same time, we need to work with our tax professionals. What I always say, look, I can pay $1,500 for someone to do the tax. That's all I'm going to get. Or I can get with the quality people and pay that fee because I'll get the money back because of my margin that they could save for us, right? And again, full disclaimer, from a massive team perspective, we are not subject matter expert. We're not legal advisors. That's Bill. He's the CPA. He gets to stamp on it. But in general, if you take a look at it, that here I will start here. That if you have a dual taxation, married filed jointly, 15% tax, you cap out at $500,000. But if you earn $500,000 at a jointly right here, you pay 35% tax, 15% on $500,000 cap, and 35% $500,000 cap. So the question is, how do we go about it? Okay, so I will set the stage, Bill, then we can take it from here. This is those are real numbers for two different people, and I can combine them together and show you what happens. So if you file the tax, look at your last year's tax return. I think it's a page number 2. They'll give you a version of that, right? In this particular case, this couple married filed jointly. In 2020, they had a 24% tax bracket, and 2021, they had 35% tax bracket. Key point, I will hit it. Total income went up. If you look at adjusted gross income, went up from 300 grand to 400 and 570,000. They had 186% growth in income. That came mostly from the business income. As you can see, salary went down. Probably they have a base plus a bonus. Something happened. Base went down, but their business income went up. So my guess, it's a working couple. One person has a W-2, another person has a business, and their gross income went up on the business side, which is healthy amount, 187%. On the income tax perspective, if you look at this highlighted total due, they paid $5,000 in 2020 for tax. They paid $146,000. That's almost 3,000% increase on the tax. $140,000 increase on their tax. Interestingly, if you take a look at it, even though that their income went up 186% at the gross level, at the net level, it went up 41%. In a sense, their tax planning was right during the year 2020. They kept 98% of what they earned. And something happened in year 2021. It was a mess. Something happened in the tax. They kept only 74% of it. So good example and a bad example, right? So all of us, we need to understand how much we earn. We need to understand our own P&L, and this is where you start. So the whole segment of this one, of the objective of this session, is tax strategy and how to go about it. So with that note, Bill, if that couple were to go to you and say, Bill, I am earning this much in year 2020, I've earned this much in 2020, and I am about to earn this much in 2021. I have 4 months left. What would you recommend? Take it over.
Yeah, so the best thing you said, they come to me before the year is over. I mean, we'll make pretend we're in 2021, but that's definitely because, unfortunately, I get a lot of people, they come to me in April and they say, hey, what can you do? I can set an appointment for this year so we can figure out how you fix it this year, but I can't always fix the previous year. But so a lot of what we do will kind of look line by line. So one of the easier ones we'll kind of look at is the Schedule C, business income or loss. So it's great self-employed income, but what we might kind of look there is, okay, we've got a large increase in the Schedule C business income. What are they doing for that income? And maybe should we look at having it taxed as an S corporation? Maybe it should actually be a C corporation. Sometimes entity structure, that has a lot to do with how we're going to file their taxes. A couple of things thinking, so right now we're getting a lot of benefits from the flow through entities. Some people call them the Trump tax cuts. There was something there was called qualified business income deduction. And if you kind of look at the numbers there, so it's almost like right in the middle of your screen. What that means is they were giving up to 20% of the profits of the Schedule C. So you got 237,000, up to 20% of that was coming off as a deduction, kind of like using a coupon, 20% off. But then if you look in 2021, it goes to zero. They all go away. And that's because for married couples, after your income reaches 330,000, you're going to have limits on what you can deduct. So one way we look at doing that is, okay, maybe we need to turn this Schedule C, and Schedule C is another word for, self-employed income. The person might have an LLC. I get the answer a lot when I ask people, like, your LLC, first time, and I haven't looked at any of their taxes, and I'll say, okay, well, how is your LLC taxed? They kind of pause, they look back and they go, as an LLC. So that exact same LLC that could be the Schedule C up there might also be taxed as an S corporation, like S. Samuel. But it could be a C corporation. But it's something to look at, because what we might want to do is take those profits and pay the owner a paycheck, a reasonable salary. And so as corporations, as long as the owner is taking a reasonable salary, the excess profits, actually, we get to save Social Security and Medicare tax on them. Now, in this case, based on that income, that means about a 3% tax savings. Although on $446,000, even 3% is $12,000. So just converting to an S corporation alone might save $12,000. Then if we're paying a payroll, we might come back and get the qualified business income deduction back. Then we might look at even stuff like, hey, now we will find out before we start making any of these tax tips. Actually, I'm sorry, I probably should have started this. I want to find out what's their cash flow needs. Do they have any, cash liquidity events coming up? Are they going to be needing cash soon? Are they going to be in an expansion phase? What are they doing? So before we recommend an entity structure, I kind of got a good idea. Hey, what's your crystal ball look like, as far as what you plan on doing 1, 3, 5 years out? Because sometimes, C corporations, they used to be, bad because they were high double tax. Now, with the way tax rates work, in some cases, they're actually a better plan. So we want to figure out from this couple, what are they doing? What type of business are they in? What type of entity they are in? Because, even the qualified business income doesn't apply to everybody. But say it's a good thing, say we can end up doing it. We may be getting that 20% coupon, knocking off the income there. And then on top of that, if they don't need the cash now, they may want to defer that money into a 401k plan. Self-employed person, they're able to put away the first $26,000 of income. And then on top of that, another 25% of their tax, their W-2 wages. And so what they'll do, I'll answer that one here in just a second. So we're able to defer those. Now, when I was talking about the S corporation and reducing the 3% tax, currently as self-employed income, they're paying Social Security, Medicare tax on everything. Well, Medicare tax and everything. Your Social Security taps out. So after 160,000, they're not paying that tax now. But so you look at the 237 and the 446, all of that is subject to Medicare tax. With an S corporation, you only pay Social Security Medicare tax on your paycheck, which becomes a deduction to the business. And because you're taking a paycheck, you may be able to qualify for that qualified business income deduction. Because even though it's a 20% off, it's based on how much you pay in wages. The nice thing though, it doesn't say wages to non-family members. It just says wages. You could pay yourself a paycheck and get the 20% off. So just kind of different things of where they play into there. Then we're going to start looking here. So now as you start seeing the Schedule E, rental and pass-throughs, this kind of becomes now like, okay, what type of business is this person doing? The self-employed business, or maybe even the W-2 business, but the self-employed, if they're in the real estate field, and they're going to end up being a landlord, meaning they're going to, it could be as a general partner or as a independent real estate operator, you know, an IRO, or just a single family. If they start getting the hours requirement, we may be able to take advantage of depreciation from investing in syndicated partnerships that we have no affiliation with. All we do is give them our money. And so there are possibilities of becoming a real estate professional with certain qualifications. So those are actually pretty specific. It's pretty easy to go over. Is it your primary occupation? Another way of saying, look at all your hours you work, and it could be one spouse or the other. It doesn't have to be both. All the hours you work during the year. And if you cut it in half, is one more hour than half equal doing real estate work? Okay, we start there. Then we say, okay, now is that number at least 750? Meaning we have to spend at least 750 hours in real estate. Now it's possible. Now on the Schedule C, maybe you're a realtor. If you could even, as an S corporation, if you own it, you could do that too. You could own a C corporation and do it. You could be a realtor. You could be a home builder. You could be, you know, flipping houses. You could be doing property management. You could be a landscaper. You could be doing all kinds of things. Does not count for mortgage brokers, but it does count for most other areas that are related to real property trade or business. Then after that, what we say is, okay, now what do you do as some type of landlord? This is where we bring both spouses in. One can even continue to work the W-2 job up at the very top, the 125. But if the two of them manage their properties together and they can get 500 hours between the two of them, we're going to qualify potentially as a real estate professional. And so we're looking now at investing in things that give us tax deductions today. Maybe one day you pay tax on it. I'm not saying they're tax-free, but what I am saying it's defer, 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 and then, well, die. So everybody dies. But the way the tax code works also, especially here in Texas with community property, when someone dies, you get a reset button and all that depreciation, you get to start all over again. It's like you get to redo it for, you know, up to $12.5, $25 million, depending on, you know, single or married. So just kind of taking advantage based on the couple's cash flow needs. Now, if they're spending everything, every penny they have, sometimes the only answer to get more money is they're going to have to make more money. So we might go through some type of budgeting process, figuring out what they're doing. Might look at some type of cost, you know, reduction analysis, meaning like, okay, what are you spending money on that maybe you don't need to? Remembering, understanding, you can only reduce your expenses down to zero. So sometimes the answer is earn more money, but then sometimes people just say, well, just earn more money. It's not always that easy. So it's kind of a combination of things, looking at, you know, how old they are. Do they have kids maybe getting ready to go for college? Do they have kids that can work? Hey, are you paying kids for working in the business already, but just not taking the deduction for it? Because if your kids are doing actual work, you can probably pay them $12,000 and the kids aren't even going to really pay any tax on it. If it's a Schedule C business with no LLC, you're not even having to pay the Social Security Medicare tax when the kids are under 17. When they're over 17, you can still pay them. They just may have to pay a Social Security Medicare tax. If you're using an LLC or you're using an S corporation, you'll have to pay the kids via W-2. So yeah, it might cost you 15% for Social Security Medicare, but you could be saving 35% off the top coming off of your income taxes there.
Yeah.
So it's not really one size fits all. It's kind of a quiver, and we just figure out which arrow we're going to pull out.
So Bill, as you kind of get into the second section, I want to recap some of my notes, make sure that I'm following you. It's a lot. So first of all, talk to your CPA, tax consultant, whatever it is, ask them for 30 minutes tax strategy on that one. But let me kind of recap. What we're saying is that we should have a 12 to 24 months outlook of what we need in terms of a cash, right? And then we take a look at it, what type of business that we have, right? And then we go after the, between those two, we figure out what type of investment I should do. First, primarily reduce the tax bracket here, and then get some qualified business deduction, right? That preferably from the S Corp, C Corp. And then from there, we have 401ks and the 3% tax savings, right? Is that the way you're thinking?
Yep. Yeah. It's kind of what we do is we kind of say, okay, let's kind of look to see what you're planning on doing.
Gotcha.
What are your plans? I mean, sometimes, honestly, some things are, say they told me we're closing the business at the end of this year anyway. Just, it's making a lot of money, but maybe it was a certain thing. It was flood restoration. I don't know. Well, in that case, we may not do any planning. I'm sorry, you may have the tax, but it's like, why do you want to spend a lot of money? I mean, above all else, don't go into a tax plan. Hey, I got this great plan that'll save you $100,000 in tax. And like, okay, I don't even have 100,000 in tax, or, I'll save you all this money and it's just going to cost you twice as much. So there is the balance between what you're going to pay for the advice and then for what it's going to save you. So I do have to depend on the taxpayers a little, like, hey, you got to help me understand, what does your next year look like? And maybe it's about the same, maybe up 5%, maybe down 5%. Okay, I can work with that. But if they tell me I have no idea, well, I don't know. I mean, it's like, you got to help me out here, because I can't give you a plan if I don't even know what target I'm shooting, north, south, east, or west.
Got it. So let's come up with a scenario, right? So let's say the couple is here. This is month number 8. We got 3.5 months left. And forecast is they need, a couple of $100,000 to stay, or maintain the life, what they have. And they're going to make right around, let's say, $500,000, right?
Yeah.
And this is a IT business, right?
Okay.
And then how would you bring that in terms of real estate investments?
Yep. So what I'd probably do is I'd have to look at, like, hey, how much money, how many hours you're spending in the IT business, and do you have employees working for you, or are you doing it all by yourself? With a couple of months left, because one of the things we're also looking at when talking on the bottom, total due after penalties and interest, one thing we may want to make sure we do before the year is over is like, hey, let's look back at last year. You had $48,553 of tax. Let's make sure we get 110%. So kind of like on the yellow line, up there, the one above it, to the left, the 48,553.
Okay.
Let's get 110% of that number paid in via your paychecks. If you're an IT company, that's a service-based company, we're probably looking at converting you to an S corporation to take advantage, because service companies are there. Now, something else we hadn't mentioned before, IT sometimes dealing with computers, they're having to spend a lot of time and effort trying to figure out how to improve their processes. And there are credits out there as well. There's called research and development tax credits, part of like Section 174, it's geek numbers. Yeah. Used to be a lot better deduction, but it's possible you're getting tax credits for money that you were already spending. Hey, let's look to see if there's a way we can recover some of this money as a tax credit. Let's look to see, hey, if you've got extra cash flow, maybe you can start deferring some of your income over into a retirement plan. And again, so we defer it now at 35%, and then maybe you pull it out later when you're in a lower bracket, 20, 25%. And even if you pull it out, to tell you the truth, if you pull it out and you're at a 37% bracket later, most people think, well, 37 is higher than 35. Well, not if you were able to push the money out for 5 years and double your money, because now with the time value of money, you're going to come out ahead still. So just kind of different strategies. 100%. It is possible the real estate here, it is possible they're not going to get the deduction if the business owner's working full-time in the business and the other spouse is working full-time in the W-2 job. Maybe they're just going to be passive investors. And in which case, what's going to come into play for them is cash flow. They're going to put money in, and then they're going to start receiving the cash flow. But when they receive that cash flow from the real estate, that total tax number does not go up. So we increase their cash flow for no increase in tax. And if there's something we can do on the tax too, let's see what we can do.
That's a good point, right? I mean, we had a little over 250-ish investors invested with us, about strong over 210 of them are working, and they want to stay at what they do, and they were really pushing the cash flow in terms of tax. So Bill, from that perspective, if somebody wants to be an LP and they're hitting that number where they cannot write off more than 3%, how would they benefit it down the way, assuming they invest every year?
So this one's pretty easy. Now, this is not necessarily my case study, but it's along the same lines. So I have a partnership, I have an S corporation, I have a W-2 job. but I'm not a real estate professional where I can take advantage of those deductions. That being said, I still invest passively in real estate. And so what I'm getting is I'm using, and I use retirement funds and I use after-tax money. I invested in there and I don't get the deduction right away. I do get a loss. I receive K1s and they show a loss on my investments for tax purposes. So I front load all my losses, and I'm in several investments because I never know when one of them is going to sell. It's like I always have to have a plan B. And then they're paying me cash flow. And as I'm receiving that cash flow, it's basically for IRS purposes, just giving me my money back. I know it's a cash on cash return. It's a return, on my investment. But as I'm receiving the cash, typically for the IRS, I'm just getting my money back. So I'm not paying any tax on it. Then when they sell, I get a large influx of cash. And I'm going to be able to offset any of those gains from my large influx from my other investments. Again, no tax. I reinvest that money back into the real estate because now I believe in a balanced portfolio. I believe, I'm not the person here to do your risk tolerance. I'm not the one saying invest this, invest there. What I'm just saying is what I do. I like the way real estate provides. I like the returns. So I reinvest it back into it and I continue the cash flow. And honestly, sometimes you start getting the cash flow. It doesn't really matter. Your tax brackets don't really matter, because if you can get a cash flow of say $10,000 and you get to keep all $10,000, who cares what your tax bracket is? I got $10,000. It's kind of like when you go to the store with a coupon that says, you get, $25 off when you spend $200. Kroger's doesn't ask you, I'm sorry, what's your tax bracket? How much is that $25 worth to you? It's $25. So you're getting the cash flow coming out to you. And then from there, the nice thing is if you don't have to worry about the taxes, gross equals net. When that investment comes again, when it matures, again, if you cash out and you say, hey, just give me all my money, I just want to cash out, I want to get off the ride, you will probably have a tax bill. But if you turn around and reinvest it into a new property, you want to evaluate what new property you're investing into to make sure it's taking depreciation deductions. You can keep deferring these tax bills. And again, it's morbid. I know we laugh about it. When somebody dies and if they're married, the surviving spouse most likely is not paying any tax. And in fact, all that stuff that we deferred all along the way, just erase it and say, hey, I get a step up in basis. The way the tax code works with the state law, all the stuff that deferred, it all goes away now.
And the way I tell my wife is that, defer the tax, follow the rules, defer the tax. We pay taxes, right? We always pay tax when the time is due. And if I could delay time value of money, that's the whole idea, right? And Bill, you kind of tie it in, right? If we're a working couple and we cannot reduce the taxable income, or our income stays at a threshold in this particular case, we should go after this Schedule E rental or pass through. If you can stack up enough credits, tax deductions, right? Then my income that's coming in, that becomes almost like a net zero impact. And then if I could time my return of my profit and my reinvestment and deduction associated with it, that also a net zero impact to me, just almost like a zero impact, right? So we can keep the revenue steady. What? Sorry.
Yep. So sometimes when we sell real estate, if it's something we've invested with inside of another partnership, it's a little more challenging, but there's ways to do it. But typically, if you own the real estate yourself and you've been taking the deductions on it and it's grown in value, now when we're talking about the timing, maybe you look at doing some type of 1031 exchange, which is another way of saying, hey, if I sell this thing, I could have a big tax bill. But if I just trade it for another property, we get to defer when we have to pay the tax. But then say it's a year, something happened, COVID, you got laid off. It just happens to be a year that all that income wasn't there that year. Well, you know what? Sometimes it's better just to pay the tax, because you know what? Sometimes it's like, hey, you know what? Tax rates aren't going to get any lower. You're going to pay 20%. You're going to pay 15% on this. Let's cash out now, take the 15% tax, reinvest it into something later that we can defer for later. Now, when this real estate sells too, here's also the nice part. Say you're two working couples, you're a passive investor, and so you're not getting the benefit of the deductions along the way. And then your investment sells. Typically, when it sells, you're going to get some type of long-term capital gain. Now, it's actually going to come in three forms, because if we recapture the depreciation, it's going to come back to you at that ordinary rate. Like, so the top 2023 federal tax brackets, 10, 12, 22, 24, 30. So investors don't have to worry about this. Just understand it'll be in your K1. Whoever prepares the tax return does have to worry about this. They have to keep track of these things. Then some of the depreciation that was on, like say the building itself, the building, the structure, the foundation, that tax, the most you'll pay is 25% tax. So people that are in the 32, 35, 37 bracket, they're paying 25% tax on that gain. You're in 24, 22, 12, or 10, you're paying that rate. Now also just understand, your long-term capital gains, if you're in the 10 or 12% bracket, that 15%, you're actually paying zero. You've got the 0% rate. Kind of like you see there when it says tax rates on long-term gains, where you have zero right there, married, joint, estates, and trusts. So it's possible you're paying zero tax on the long-term capital gain. But even if we just say 25%, but somebody who's in the 32% bracket, they've got $100,000 of losses from their real estate deals, and they pick up $100,000 of gains. Well, the $100,000 of gains might cost them, say, $20,000, but the $100,000 of losses will save them $32,000. So actually, for what a normal person thinks, I'm up 100, I'm down 100, I break even, actually could turn into be a $12,000 refund on their taxes that year. So that working couple that's paying all those tax, because they've deferred the real estate losses, and because when they sell it's at a capital gains rate, they could end up, that $100,000 could turn into a $12,000 profit, a $12,000 refund. Again, freeing up more cash flow.
Yep. I mean, so Bill, would you say that, as an investor, right? If we're W-2 income, we should keep the W-2 income, then increase the business income, then increase the investment income. Then we could have this kind of tools in our toolkit and optimize the investment income for taxation, and then optimize the business income for taxation using some of the tools here and some of the deduction that we talked about.
Oh yeah, I mean, many times having a business is, okay, that's honestly one of the biggest tax shelters there are, legally. As long as we're doing things legally, sometimes that's where you were spending money anyway, but now you're gonna take tax advantage of it. And then depending on the entity structure, you can also control how much tax you pay and when. But passively investing with W-2 income, here's the nice part. It's gonna eventually start paying you cash flow. Your first deal is not gonna make you, well, maybe, but typically the first deal is not gonna make you rich. So you're gonna have to get into a couple of deals. But as they start increasing, you into another deal and you start leveraging more, at some point, could be, 8, 10 years down the road, but at some point, that cash flow, because like even the person making 125,000 up top, they're making 125, but they're not keeping 125. They're probably keeping about 80, maybe 90. So if we could replace that 80 or 90 worth of cash flow from real estate deals, they could quit their job because they're going to be making the same amount of money. Then say they want to start managing their own deals, they want to start managing their own property. Well, they don't have to work a W-2 anymore. Now they're working in real estate. They're doing actual real estate work. They are now can take those losses and offset them against the 446. And so they're no longer working the W-2 job. And now they'll be able to take losses to offset the 446, again, reducing their tax burden. And so it's actually could be increasing their take-home net pay.
On that note, it doesn't happen instantaneously. If you have W-2, stay there, hand it out. Whole point is going out there, talk to your tax professional, improve the understanding, have a plan, right?
Yeah, and if people love their W-2 job, don't leave. I mean,
don't leave.
There's nothing wrong with working when you enjoy it. It's just, if you're getting the Sunday night jitters, meaning, before you get to work Monday, maybe you should be looking, at other alternatives.
I mean, hey, look, it's domain transfers is expensive. It takes a lot for you to transfer, and coming in instantaneously is tough, but Bill is right. If you get that drag view on a Monday, to get ready for Monday. I know most of us, we had it at some point in our life, and when it get increases it, you have to plan it out. The whole point of this and of this whole sessions are get ahead of the curve. Let's not find out in January 1st, oops, we made a mistake in December last year. We still have 4 months or 3.5 months. Work it.
Yes, that's
right now.
especially true if anybody's tapping into some type of money. So we worked great scenarios there. That's very typical. Again, W-2 income, self-employment income, but sometimes people tap into other income sources in order to invest in the real estate. They might tap in early to their IRA or their 401k, and which is fine as long as you go into it with eyes wide open, because sometimes they may say, hey, we'll withhold 10%. And people hear that and they think, yeah, I already paid all my taxes on it. And it's like, whoa. It's like, we go, like, you look at your tax brackets over there on the left. If you cash out of an IRA early and you're in, say, the 32% bracket, you're actually in the 42% bracket if you're under 59.5. So there's different things to do. Now, there actually are ways to get the money out and avoid the 10% penalty. And if you're working at a job, to tap into your retirement plan while still working. You don't have to quit. You don't have to turn 60. Doesn't happen in every single case, and it doesn't apply to every single state in the United States, but it is possible.
Bill, thank you. And we have about 13 minutes. I will stop sharing, go to the Q&A. But one thing to remember, 2022 was the last year for 100% depreciation. 2023 is 80%. Then 2024 is 60%. Anybody wants to get the accelerated depreciation, took it last year, stack it. I mean, get them as much as you can, as fast as you can. It's going away. So just keep that in mind as you go. On that note, Bill, I'll stop sharing, and then we'll go for the Q&A, and I'll take some of the questions. Bill, you see the Q&As right we have?
Yes.
And Trevor, would you help
So
me
I'm
with
looking
it?
at one here right now, kind of going back. So looks like one of the early ones was, what about Social Security wages, tax and Medicare, W-2? So yes, the answer is, if currently everything's subject to Social Security, Medicare when you're self-employed. If you were to convert to an S corporation, the profits are not subject to Social Security, Medicare, as long as you're taking a reasonable salary. So again, don't do something like, and I see another one, someone wrote they're making 700,000 profit. Don't pay yourself 25,000 a year and say it's reasonable. Reasonable is another way of saying, hey, if you fired yourself and had to hire somebody to replace you, how much would that cost? Now, if you can have a business that runs 700,000 a year and you can pay someone 25,000 a year to do it, you should, and get out of it. So the answer is yes. There are the W-2, not on the profits.
Bill, there's a Q&A on the Ali ask a question. You could take a look at it. We get that quite a bit.
Okay, yeah. So I'm in the chats. I'm not seeing anything on the Q&A itself. Let's see. I see the summary. So setting up the LLC as the S Corp. Quick, so you understand.
Okay.
There's slightly different things. LLCs are based in the state. So you first set up your LLC, and then you have to elect how you want that LLC to be taxed. Now, if you don't make a choice, you still have made a choice, because by doing nothing, you've elected for it to be disregarded, which means it just goes back to whoever owns it. If you want it to be an S corporation, then you make an election. It's called to check the box. You can do that there. Let's see. Okay, here's one.
The last one.
I have one LLC S Corp,
Yep.
provides service and earns 700. I have another LLC partnership that only invests in multifamily syndications. And so let's see, I'm kind of reading the questions. I'm kind of reading it back out. Wife spends most of her time in first corporation that earns, and then the other one spends 750 hours a year finding, understanding, evaluating deals. Can I call myself a real estate professional and get the full depreciation? Don't think so based on what you're saying. Let me explain why. So you want 750 hours actually working in the real estate, in real property field. It could be as a lead investor. It could be as a syndicator. It could be as a builder. It could be as managing your properties. It is possible, maybe you're 750 hours a year finding, understanding, and evaluating deals. But what I don't see in the question is the 500 hours of active management. And that's going to be important. That's where people, they think real estate professional, but they miss with active participation. Now, the nice part is the active participation, if you're married, you could do 250 hours each, you and the spouse, and you'll qualify for the 500. active participation is another way of saying doing things that the people that sign the front of the checks do. Right? Every millennial just said, "What the hell's a check?" And so for those of you that know what checks are, those that sign the front of the check and not the back, you have to be able to be in a position to have exercise management control. You could own an apartment complex and you can have a property management company run it, but they have to do what you direct them to do. So you have to have the ability to direct and control what that real estate that you own does. And all your time as a passive, you could invest millions of dollars and be in millions of passive deals. As a passive, you get 0 hours for that. You have to be able to be somebody in control.
Bill, let me twist that question a little bit more, right?
So
Working couple. Sorry, go ahead, Ali.
Yeah, so if I have a one rental single family home, would I be able to qualify?
So
That is
it's a
active.
two-part answer. You would have to be able to prove that you had the 750 hours or, at least 500, potentially the 750 hours. And if you're spending 750 hours on a single family rental, you need to talk to Schreier for their education class because that's way too many hours. So typically what I see is it takes about 10 to 15 doors to get there. I'm not saying it's, can't happen, but it's kind of like somebody who works a full-time job of 2,000 hours and they say they spend 2,001 on the real estate. In theory, Jordan Alvarez could hit 200 home runs if he's up the bat 200 times. You could hit a home run every time. Not going to happen, but in theory it could. So I would most likely be saying that you need to make sure and document it. And what you're doing, when I say documentation, I get that question. I was like, well, how do I document my hours? What would I do? I can tell them what it is, but it's usually better for me to tell them, okay, here, consider this scenario. You own a business. You have somebody who works for you. And the only way you've agreed to pay them is that you say, hey, at the end of the week, you need to give me a report telling me what you did. What will it take to convince you to write a check from your money and give it to them when you told them, I want you to do real estate transactions for me? They could tell you, hey, I spent 40 hours this week doing real estate. I'm not paying you for that. They go, I'm sorry, 8 hours a day for 5 days. I'm not paying you for that. But the more detail, like, okay, hey, I was looking up on MLS, hey, I renegotiated these contracts for the rents. I've been evaluating what it takes for the going market rate. Hey, I think this cap rate, if we were to sell it, we can sell it at a 5. These things, I've got these contractors coming in to do my remodeling. Those type things, the more stuff you can show and keep track of, that's going to be the more things that's going to prove you're actually working in real estate.
So Bill, how many houses you need to call it? Because it's a 750 hours, 500 hours is like a 1/4 of a full time.
Yeah.
So how many houses do you need to have
My
to say,
experience, so from my clients, and I've got a couple hundred clients, it takes about 10 to 15 doors. Now you could get there maybe in one small apartment complex, or it might take 10 to 15 single families, 6 or 7
Airbnb
duplexes.
How about Airbnb? If you do Airbnb, can you?
So actually Airbnbs have something completely different should you decide to go there. There's something called a short-term rental exception. Basically, everything I said about 750 hours and 500, scratch all that. Do you spend at least 100 hours in the business per year? So are you considered active? Now, imagine a pendulum. If you understand like what a hotel is, people don't typically own hotels. You go in, you pay for, the daily rates, and then apartments, you sign a 1-year lease. Airbnbs are a lot closer to a hotel. You now own a business. Those are not even considered real estate. That's considered an active trade or business. And so if you're able to then to show that you're active in the business, meaning an active is defined as 100 hours, you could have the W-2 job. You can have your own business and you're getting full deduction for the Airbnb. Just remember on the other side, though, that when you have profits, it's self-employed business and it's subject to Social Security and Medicare tax.
So Bill, just to kind of make sure, kind of close the loop, if you are actively working on it, Then Airbnb gets you a little bit more lower threshold and you can still get to it, right? But key point, remember, actively, you're managing a business, right? It's a different skill set, different winning mechanics to do it. It's a lot more active. You got to be in the thick of a lot of things. Going back, Bill, if I have 2,000, if I have, let's say me and my wife both working and we're spending 2,000 hours every year. Now, can on top of the W-2, let's say, fine, I work double the time, right, 60 hours a week. Can I still qualify myself as a real estate professional between me and my wife, assuming we spend 300 hours or 350 hours on average by each of us?
So you would need on your time, maybe you work part-time, like you work 20 hours a week. So that's 1,000 hours a year. You're going to need 1,001 hours in real estate. You as an individual specifically will need 1,001. And I know I said 754. 750 is the base. It's always at least 750. But then if your other work hours are more than 750, you always got to stay ahead.
Yes.
So say you have 1,001 hours in the real estate, and that could be in real estate world, property management, construction, landscaping. If you have that, then between you and your wife, if you manage everything together, if y'all two do 250 together, managing your own properties, single family, apartment complexes, then you will qualify as a real estate professional and you can take the deductions on your joint return. But again, it's all independent of any passive deal. Just understand this, when you're invested passively, zero credit for a real estate professional. Now, some people in here, they go, well, I'll form an S corporation and then my S corporation will buy passively into these investments. No, I'll form a partnership. It doesn't work because ultimately it's still all based on what is the activity, and it defaults to a passive activity. Plus also, I don't recommend owning real estate in an S corporation. We can get more into, if we have time, I can talk about it. The reason being the losses, we're talking about taking all these losses.
Bill, we have two questions.
Anything that carries a mortgage with an S corporation, the only losses you can take with an S corporation are when it's your personal money invested. You get zero leverage when it's an S corporation on a mortgage to the other property. Different rules for partnerships, different rules when you're self-employed. You can leverage the real estate, which that's what real estate's about. The qualified non-recourse financing, leveraging the mortgage. You put it inside of an S corporation, man, okay, I guess not only did you shoot yourself in the foot, you reloaded and aimed a little bit higher.
Yeah, 100% agree, right? Which is, if you put together everything else, yes, we can go chase everything else. And also there is a generic vibe that lots of people walk the same path we are about to walk, or we walked, or we are walking, right? Point is, if you have a W-2, if you have a business, stay in your lane, keep doing it. Your incremental value is higher. That's what we see. And you start investing in an asset class that gets you a accelerated depreciation. You might not realize it right now, but you're building a bank.
Yep.
So when the time comes to get out, you get a net zero impact. That's the typical play. So Ram, you ask a question about, your wife has a W-2 and you qualify for REP. Let's say you do, then you need to invest in a certain asset class that gives you an accelerated depreciation, and you have unlimited write-offs. So you can internalize that even faster. Right?
That is correct. So at that point, if one person qualifies and the other spouse is a high income earning spouse, the real estate professional with active participation can get all of these losses. Now I understand it's a time value of money. Some people, I hear them say, it's all tax-free, it's all tax-free. It is not tax-free. Understand, it's like an advance on a paycheck. One day the bill comes due, and if you go into it with eyes wide open, it's great. I mean, because you can keep deferring, but it's just one of those, some people, they, a couple years later, they cash everything out, then they get this bill, and they're like, nobody ever told me, And then one last thing, sorry. It's about 10 to 15 doors. That's my experience. That's not the IRS's. If you have 10 or 15, you qualify. It's based on hours. The 100 hours that's to be active in any business you own. Even in that IT company, like the example that we had, that person, he would need to have at least 100 hours in there in order to qualify as, being active in that business. Short-term rental, Airbnb, VRBO, that's considered an active trader business. That's not even real estate. So actually, if you elect to treat that for the short-term rental, none of those hours count towards real estate. At that point, it's like you own a consulting company. It's like a consultant, meaning you take the deductions in full, but understand also it's a regular company. It's not a real estate company.
Bill, thank you. And if you look at the Q&A, we have a question. It is, I'm an RE professional. I manage my own rentals and develop buildings on an empty lot. Can I depreciate the new home at 80% this year?
So this is actually a good question. And because when people hear the 100% write-off, 80% write-off. So here's what cost segregation is. Most people they see a building, and if they just see one building on top of land, then the building itself would take 27.5 years to depreciate. But if you break the building down, kind of like you do an X-ray on it, it's another way. The way I describe it is, I got a hamburger here. Do you see a hamburger, or do you see 2 all beef patties, special sauce, pickles, cheese, lettuce, and a sesame seed bun? When you break the house down, how much for my air conditioner, how much for my landscaping, how much for my windows, how much for my doors, how much for the roof, how much for the walls, how much for the driveway? When you break those things down, a portion of that building will break down to being depreciated in under 20 years. What the law says, hey, if it's under 20, like the law says, hey, you could depreciate the air conditioner over 7 years. 7 is less than 20. Basically, cost segregation, what that does, that breaks down the components into 3, 5, 7, 15, 25 years. The bonus depreciation says, oh, by the way, not only is it 3, 5, 7 years, 15 years, if you want, because it's less than 20, you can go ahead and write off, if it was last year, 100% of it. This year, you could write off 80% of the portion that's listed for less than 20 years. Now, here's the important thing. Some people have had buildings for more than, they didn't buy them this year. Maybe you're in real estate. Maybe you own a commercial building. Maybe you own an apartment complex. Maybe they're single family houses and you bought them 4 or 5 years ago, but you never knew what this cost segregation thing was. And you go, you know what? I think I'd like to do that. It's not, you don't have to choose it on the first year. It's easier on the first year. But if you bought it in 2022 or earlier, you're still eligible for the 100%. The 80% applies to buildings purchased in 2023.
That's right. So Bill, thank you.
Yeah, so first of all, who thinks that this was mind-boggling? Let's give Bill some love in the chat. Again, this is absolutely amazing. In theory, we're officially done, but it doesn't mean we stop. I want to make sure everybody knows that we do this every Wednesday. Next week, we're doing just networking. So remember, your network is your net worth. So if you want to meet your future partners, you want to meet people that are passionate about what they do, make sure you come. And clearly, Bill, thank you so much. You make tax sound simple and you make it fun. And we're eating hamburgers and then we're dying. That's what I figured out. So, but again, always such a pleasure to have you here. You bring so much value.
We can even use a Boca burger for those that don't like meat.
I mean, hey, look, the point is consult with your physician before you eat the burger, right? Know how the best way to appreciate the taste of it, best ingredient out of it.
All of our sessions are on our YouTube channel. I posted the link there. And we go back, there's some amazing, like you could spend the next 3 months watching all the videos of all the different webinars we've been doing. There's a lot of great information there.
So one thing we like to do on that one, for us, we are case study heavy, right? That means we hear a lot and we kind of want to do a lot, but for us, we try to break it down. Say, hey, let's bring out somebody else's real life example, boom. And then if we do a case study, it becomes clearer. So we like to do case study, and Bill, we appreciate the whole thing. For us, we are in the same boat as you guys are. We are active investors. We earn, we redeploy. The point is, have as many options as you can, so we can choose to deploy whatever option that we want to do, and then the rest is whatever it is, right? And we have only 3.5 months left, ish. Plan. Reach out to whoever that you work with you for your tax. Reach out to them and have a 30 minutes and tax strategy and execute on it. As you can see on the P&L, every time I take a look at it, I was like, that couple on the right side left at least 30, 40 grand on the table just because. A 30 minutes phone call, 2 hours of headache, 10 hours of homework could have saved you 10, 20 grand. That's a lot of money. So sometimes we forget that we need to start with ourselves, our P&L, and have a broader view. What we see oftentimes, we have a short-sighted view. I have one investment, best way to do it. That's one way. But think about it, you're here because you want to invest. So you are going to invest multiple times a year for a long time. Have a little bit more rhythmic view and then go for it.
So there is a question, the difference between C and S corporations. And that's a good one to understand.
Okay. Oh, sorry, I was trying to type an answer. So a C corporation is basically its own person. And so that means just like you as an individual file taxes, your C Corp pays taxes. S Corps and partnerships, they're kind of more like a spaghetti colander. So we keep talking about food. But with the spaghetti colander, you pour water in. If it's hot water or cold water, if it's a profit or if it's a loss, it doesn't matter. It all flows out to the owners. A C corporation stays because it's its own person. Whatever the profits are of a C corporation, the corporation will pay a flat 21%, and that's to the IRS. Depending on what state you're in, you might have state income taxes. But the C corporation will pay 21% to the IRS. Where that sometimes works out is, if you're in the 37% bracket, you make $100, plus Social Security and Medicare, you might only be taking home $50, $55. Whereas with a C corporation, if you had profits in a C corporation, you could be having $79 left in the C corporation to turn around and reinvest. Now, that being said, it's not always the most efficient way if you're looking to get cash in your pocket. But if you're looking to, hey, I don't need the cash, I want to maximize cash available for future investments, C corporation. Additionally, if anybody here is like a foreign national, now you don't have to be a citizen, but if anybody's like not a resident of the United States, or maybe y'all are capital raisers and you're looking to go out and raise money from people that are not in the US, it is better to have anybody who's a foreign national own the C corporation because there's a lot of backup withholding rules. That being said, you want to make sure you do it right. Whether it's me or somebody, you can get another tax professional, that's fine. But because if you mess up a C corporation that's owned by a foreign national, the penalties start at $10,000. So you kind of want to make sure you do those right. But a C corporation, sometimes people even use them, and they use them in connection with like life insurance, and they'll do things called like infinity banking. They just start making money, and because more money is there to recycle to grow for later, they're actually growing more. Finally, depending on what type of business you're in, some people form C corporations, and there's a provision in the law that if they sell them 10 years later, they can exclude up to $10 million of gain. So like that IT company, if they told me, look, I don't need the cash, I'm not looking for anything. In fact, actually, you know what? I've got this product, I think we're going to develop this software and we're going to take it public, or I think private equity is going to buy me out. And I think they're going to give me like $10 million, and it's going to be, 7 years down the road. So it's more than 5. I said 10, I meant 5. I might recommend C corporation, and here's why. Hey, you're going to pay a little more tax now, but that $10 million when you sell, how would you like for it to be tax free? And in this, I mean free as in zero. So you look a little bit further down the road, and it's like, hey, and so it's a trade-off. Again, if you're looking for cash flow now, S Corp, partnership, disregarded, probably better. I don't need it now. I want to preserve as much cash as I can because I got to buy out another shareholder, or I'm trying to pay as little tax as possible. I don't need the cash. Maybe C corporation.
100%. Now, Bill, thank you.